Welcome to today's episode of the Simply Financial Podcast. I'm your host, Christopher Calandra, and I want to increase your financial IQ with today's episode. What I want to discuss with you today is two things I'm thinking about as 2024 winds down, and the team and I here at Elliott Wealth Management begins to make plans for 2025, including some of our base forecasts for the year economically and expectations for the market, which will relate to how we want to position client portfolios and what our risk profile might be for the year. So two things I want to share with you. The first thing is in November of 2024, U.S. consumers in a survey said they expected the market to rise again next year, that being 2025. So this is good news. That 56.4% is the highest on record. Again, good news. There's been optimism all year in 2024. We've seen investors be rewarded with good returns. The market, as of this recording, which is early to mid-December, the market has gained strength since the election. We have avoided a recession. There's no talk of a recession. We have manageable inflation, a growing economy, and there's a lot of optimism surrounding the direction of the country now that we know who the next president is going to be. Incredibly, I think there's a lot of optimism about the Trump administration. For those of you that did not vote for him, that may seem strange, but I think that there's general acceptance that it may be a good thing. He has a lot to deliver on, but as of this time, there's a lot of optimism. So that's good news, but not so fast, because on the other hand, this is what I'm thinking about and what we're thinking about is this a contrarian indicator? Is it necessarily a good thing that consumers are so optimistic and bullish about the stock market? Could be a contrarian indicator. I'm not sure exactly how I feel about this in the complete sense. I don't think I view this as a very positive note. Now, we and I have been positive, optimistic about the economy and the markets going back to mid to late 2022. And that optimism has paid off because the market has had a great 25, 26 month run since then. So that's the first thing I wanted to share with you that we are thinking about, that I am thinking about as we move forward. The second thing is I want to draw your attention to the S&P 500. So this is one of the major U.S. stock market indexes. I think it can be described as the bellwether index along with the Dow Jones Industrial Average, but it's definitely considered one of the best proxies for the stock market. So when you look at the S&P 500 today, after a great market performance in 2023, and so far at this late juncture in 2024, the S&P 500 has become expensive by many metrics. I'm going to talk about the metric of price to earnings ratio. So it's basically the price of the stocks in the S&P 500 as a ratio to the earnings that the companies are expected to generate. So the forward price to earnings ratio for the S&P 500 is 22.3. Now, I know if you're listening to this, it's probably not something that you're keeping track of. You may not even be familiar with price to earnings ratio. I don't want to go too far into weeds, but know that the higher the price to earnings ratio, the higher the forward price to earnings ratio, the more expensive the index, in this case, the S&P 500, is considered. Now, expensive doesn't necessarily mean bad. It could be expensive for a long time. It could be expensive, and that means that it's about to get less expensive. You don't know. I don't have a crystal ball. But when we look at history, it is at 22.3% now. The 5-year average of the S&P 500 on a forward price to earnings ratio, meaning expectations for the following year, the 5-year average is 19.7. So it's quite a bit higher than the 5-year average. The 10-year average was even lower. The 10-year average is 18.1. So as 2024 winds down, we're looking at an S&P 500 that is expensive compared to the 5-year average and the 10-year average. Once again, I know I'm repeating myself. I'm talking about forward price to earnings ratio. I am emphasizing that because there are other metrics that can be used to determine or help to determine someone's opinion on whether it's expensive or not. So higher than the 5-year average, higher than the 10-year average. And when you dig a little deeper into the research, you find that it's the most expensive it's been since 2021. It's not that long ago. But more importantly, there has only been 2 times since 1985 that the S&P 500 had a forward PE that is higher than 22. It did so for roughly 3 years, from 1998 through 2000. It was above 22. And if you go back then, some of you listeners would have been investors at that time. Others may not have been so because you're young. Congrats. But during that period, it was the tech bubble. We call it a tech bubble now. At that point, it was the tech revolution, the internet boom, and they were great, great years for the markets. Although that ended badly because you had the tech bubble, the tech wreck, where the market went down for 3 consecutive years, 2001, 2002, and 2003. So that great, great run-up was followed by 3 very difficult years. The other time that it went over 22, the forward price to earnings ratio went over 22, was more recent. That was after the run-up, after the COVID sell-off in March and April of 2020. The markets went on a tear, expecting COVID to create economic growth. Still kind of bizarre how fast and furious that market rally was to me. So that was a good period. The market was up in 2000, was up in 2001, but the earnings of companies were lagging behind the strength of the stock prices. As they went up, the earnings companies still coming out of the COVID mess didn't really keep pace, and that led to a price to earnings ratio that was over 22. Now, remember that 2022 was not a good year for the market because then you had inflation. And so that temporary period when the price to earnings ratio, the forward price to earnings ratio was over 22, didn't last very long because we had the sharp sell-off in 2022, largely driven by the inflation problem. So I think about this because this expensive element of the S&P 500 gives me cause to be a bit concerned. Again, I'm sharing with you thoughts. You should not invest anything based on what I'm sharing with you. This is almost like brainstorming, open dialogue, give you a little insight into the work that we're going to be doing over the next few weeks and next few months as we plan for 2025 to hopefully serve our clients well and have them positioned appropriately in the investment portfolios that we are running for clients. So just to review, consumer confidence in the stock market being able to deliver positive returns next year is the highest it's ever been. On one hand, that's very good news. On the other hand, might be a little worrisome, especially if you're a contrarian, which I tend to be. And the other thing is the expensive nature of the S&P 500 when you look at forward price to earnings ratio. So that's today's discussion, food for thought. I will be discussing this with the team here as we meet over the next few weeks and months. For clients, it's going to be a common discussion topic. If you're clients of ours, expect to hear some information about this and some more fully formed thoughts. If you're not a client and you're interested in talking to us, we would love to do so. Go to the website, elliottwealth.com. You could get more information about us and the work we do. Please, as we wrap up, subscribe to the podcast if you haven't done so already. And I'll be back with you for the next episode of the Simply Financial podcast very soon. Thank you so much for listening today.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.